Eric, will you tell us something that you believe about cost segregation studies that might surprise us?
That's a great question, Jonathan. I think the most surprising thing is that they are still extremely underutilized. So, cost segregation has been around for a number of years, and with some of the changes to the tax law, it became more popular in the last 4 or 5 years. But I can't tell you, Jonathan, how many people I still meet who maybe have heard of the term but don't necessarily understand it or don't apply it in their own real estate portfolio. So that's probably the most surprising thing is that it's still very underutilized.
Welcome to the source of commercial real estate, where we talk to the experts in commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I found financial freedom through residential real estate investing, and now I invest in commercial properties, particularly small industrial properties. And today I am talking with Eric Oliver. He is with Cost Segregation Authority, and he has a passion for educating and informing CPAs and commercial real estate owners about the benefits of cost segregation. Eric, thank you so much for joining me. How's it going today?
Good. Thanks for having me, Jonathan. I'm glad to be here.
Eric, why don't we start the conversation with you telling us more about your background and what your work looks like today?
Yeah, so kind of my background, my degree is in accounting. I went to college and wanted to get through college as quickly as possible, like most of us. And so I'm never good at writing papers, never good at the sciences. So I said, okay, math is something that comes somewhat easy for me. So originally it was a finance degree, and then it turned it into an accounting degree once I found out that there were fewer classes I had to take to get done with college. So kind of by default, accounting became kind of my specialty. Shortly after college, I actually ended up in a business development position that took me to Richmond, Virginia. So I was born and raised in Salt Lake, lived in Richmond, Virginia for about 12 years, left there, went to Long Island, New York for 5, kind of totally switched gears and was doing landscaping there. My father in law has had a landscaping business in Long Island for about 30. My wife and I thought we wanted to take that adventure on and buy that business from him. We ended up not buying it. Actually moved back to Salt Lake. I had some aging parents and ended up back in Salt Lake, and I was looking for a job, and kind of my background again was accounting, business development, and came across this company called Cost Segregation Authority. At the time, Jonathan, I had no idea what cost segregation was. I actually had to Google it before I had my job interview to find out, sound somewhat intelligent about it. I had dabbled in real estate a little bit. I had a couple primary homes that I had turned into rental properties over the years, but came across this job. I was hired. I've been doing it for 8 years. Love it. Love working with investors, tax preparers on helping reduce tax liabilities through cost segregation. And that's kind of what's brought me here. So it's been a great run.
I imagine splitting this conversation up into two parts, sort of. So, the first part being kind of an FAQ about cost segregations, because, like you alluded to in your intro, there are some people out there that aren't familiar with cost segregation studies. And then I'd like to go into the current state of cost segs. And so, why don't we start out with you giving us kind of a breakdown of cost segregations? And for listeners unfamiliar with cost segregations, you do not have to be a CPA. You do not have to be a numbers wizard. You do not have to have this like intimate knowledge of the finances behind commercial real estate to take advantage of cost segregation studies. I take advantage of cost segregation studies, and I'm certainly not a numbers wizard. So stay with us because there are massive benefits to cost seg. So, Eric, will you give us an overview of what is a cost seg, who's it for, and how's it beneficial?
Yeah, great question, Jonathan. So cost segregation really is just accelerated depreciation on your real estate assets. So, one of the great benefits of owning real estate is the ability to take this non cash expense every year. So, remember, when we get taxed, we have our income and then we have all of our expenses. And then whatever money we're left with, that's what the government taxes us on. And so, the more expenses I have, the lower my income appears to be, which means I pay less taxes. And so, depreciation is just a non cash expense. And like I said, one of the benefits of owning real estate is we get to depreciate our real estate if it's a commercial building over 39 years, residential units over 27 and a half. So just to make the math easy, Jonathan, let's say I buy a $390,000 office condo. I essentially take 390,000, divide it by 39 years, and I'm going to get a $10,000 expense every year for the next 39 years. Now, I've oversimplified that a little bit. Land is non depreciable, so you always have to back out your land value when you make your purchase. Essentially, the government's saying, hey, that office structure is going to slowly deteriorate over time. And so we're going to let you write off that expense. And that's great. That's, again, one of the benefits of owning real estate is for those deductions. Now, I may not own my office for 39 years. I want my deductions now. So is there a way I can take more of that now versus taking that standard 139th every year for the next 39 years? And the way we do that is through an engineering based study. And just as the name implies, cost segregation, we go into this office building. We say, okay, you paid $390 for this office building, but the window coverings were $12,000. The flooring is $8,000. The cabinets in the break room are $12,000. We segregate the cost into different buckets, per se, or asset classes. By doing that, the IRS says, well, carpet doesn't last 39 years. Carpet's only a 5-year asset. It lasts typically 5 years. So we're going to depreciate carpet over 5 years versus 39. So we come in and we take that $390,000 purchase price and break it up into different buckets, which allows you and your tax preparer to depreciate it at a much faster rate. I'll use a quick analogy because I like food, and my kids always ask me, Dad, what is it that you do for a living? So when you go to McDonald's and you buy a hamburger, you pay, I don't know what a McDonald's hamburger is now, $7. But what we do is we say, okay, of that $7, the pickle was 85 cents, the beef patty was $1.75, the ketchup is, and we break that cost up into its individual components. So when you buy real estate, it's hard to do that because you're just buying an existing building for example, for 390,000, you don't know what the parking lot's worth or the carpet's worth. And so that's where cost segregation comes in, breaks those different components up, which allows you and your CPA or tax preparer to depreciate those at a much faster rate. Now, why would we want to do that, Jonathan? So there's a number of reasons why. The first one is there's a time value of money element. I want my deductions now versus letting the IRS hold on to these for the next 39 years, number one. Number two, I may not own my property for 39 years, so give me my deductions or as much of those deductions as I can take now, again, versus letting the IRS hold on to them. And then you've got the inflation portion. You know, a dollar today is worth way more than a dollar 27 and a half or 39 years from now. And so I want to use those dollars, create as much depreciation as I can, because now I've got my income, I've got this big depreciation number, which means I'm going to owe very little taxes. And by doing that, it creates cash flow in those early years that I can then take that cash flow and go buy a new property, go buy a new duplex, pay down my debt. I don't know, buy Bitcoin if people are still buying Bitcoin. I think they are. I think Bitcoin's at an all-time high, or it has been recently. So that's the idea, is to create cash flow in those early years so I can put my money to work versus letting the IRS hold on to it. One last thing I'll say is that if you're not doing cost segregation, technically, according to the tax code, you're doing it incorrectly. Now, the IRS is never going to come tell you, Jonathan, hey, you're not depreciating your carpet fast enough, because that's just more money in their pocket if you don't depreciate it the correct way. But technically, you are actually doing it wrong because you're depreciating your carpet over 39 years. And the IRS clearly states that carpet is a 5-year asset and should be depreciated over 5 years. So that's kind of cost segregation at a high level. Again, we're just front loading or taking your depreciation at a much faster rate.
And to be clear about what you were talking about, this is a law. This is not a loophole. We are not going around the IRS. We are not being tricky. We're not trying to trick the IRS into avoiding taxes. The IRS says if you own real estate, you must depreciate it. But this bonus depreciation, accelerated depreciation, came into effect. It got a lot of notoriety a few years ago with Trump's tax plan. So yeah, just to clarify for listeners, this is not a loophole. This is a law that's on the books, and this is on the up and up, and one of the many benefits of real estate. And so you, Erik, have talked about office a little bit. Are there certain asset classes that cost segregation works really, really well for? Other asset classes that it's not worth doing? How do you see it based on different asset classes?
Yeah, as far as asset classes go, I can't think of an asset class where it's not worth doing cost segregation. So there will be variances on how much deduction you can get or how much you can accelerate. So when you think about different asset classes, let's look at maybe a warehouse, for example, where you've got just a metal box on a cement floor, nothing really inside of it. There's not a lot for us to segregate or pull out of that structure. So usually we'll get about 15 to 20%, mostly exterior stuff. So usually at a warehouse, you've got parking lots, curbs, gutters, asphalt, maybe grass, retention ponds, drainage, all that stuff is a 15-year category. So we'll pull that stuff out, but the interior portion of that warehouse, there's not a lot for us to get. So again, we might get 15 to 20% segregation. Now, contrary to that, you've got multifamily where you've got a lot of outside stuff, plus you got a lot of stuff inside those units. And so usually on multifamily, we'll get 30 to 35%. Kind of the industry average, just the quick back of the napkin type math. I always say on average, we segregate around 30% for about 85% of the asset classes. Now, again, some might be 20, some might be 35, but it kind of averages out about 30%. There are three unique asset classes that are outside of that norm. One of them being car washes. I don't know about you, Jonathan, but here in the Salt Lake Valley, there's car washes just about on every corner now. And part of that reason is they are a huge tax deduction. So when you buy or build a car wash, what are you actually buying? You're not buying a building typically. You're buying land improvements, things like curbs, gutters, asphalt. And then you're also buying a bunch of equipment. All of that stuff I just mentioned can be depreciated over a much faster useful life than 39 years. But oftentimes we'll see that incorrectly on a depreciation schedule where a lot of tax preparers will consider a car wash commercial property. So they depreciate it over 39 years. But when you look at what it actually consists of, again, it's just 15-year land improvements plus equipment. So car washes, if you buy $1 million car wash, it's not uncommon for us to segregate 80, 90, sometimes even 100% of that into short asset lives, depending on the type of car wash. So car washes are unique. Gas stations are unique. Again, gas stations, if you sell more gas than you do convenience store goods, gas stations, the whole gas station can be reclassified as a 15-year asset. And then the other one that's unique is mobile home parks. So mobile home parks, again, when you buy a mobile home park, what are you really buying? You're buying a bunch of roads and dirt and gutters. You're buying trailer services, cement pads. So you're not really buying a 39-year structure. You're buying 15-year land improvements. And so when we can do that, we can front load and take that over 15 years versus 39 years. And then you had mentioned something, Jonathan, and I imagine we'll get into it, but bonus depreciation just allows you to take those 15-year assets at a much faster rate than even 15 years. And so those are kind of three unique, but on average, it's about 30% for most asset classes. Some will get a little bit more, some a little less, but that's a good number to use.
Okay. And so let's walk through kind of the process of getting a cost segregation, because based on what you said, I think a novice investor or someone without experience in cost segregation could say, man, it sounds like a lot of work. I have to do I have to measure the carpet and count lighting fixtures and know about the sewer that's going under my mobile home park? I don't want to take all this on. So, can you walk us through someone that's interested that thinks maybe, I'm going to have a lot of income this year, and so maybe this cost seg could be right for me? What's the process like of getting one?
Yeah, great question. So the first thing you want to do, Jonathan, is you want to get a benefit analysis run first. So most reputable cost segregation companies are going to provide you with an estimate before they ever engage you to use their service. So initial benefit analysis, we're going to look at your property and we're going to say, okay, we anticipate segregating X amount. This is what your depreciation is going to look like. This is what your tax savings is going to look like. And this is what our fee is to conduct that study. So that's the first thing. Always get a benefit analysis done.
And
Yeah,
that benefit analysis is totally free, right?
totally free. Yeah, most companies, it's totally free. We can usually turn it around in a day or two. We just need some basic information. How much did you pay for the property? When did you buy it? Did you 1031 exchange? What's the address? There's just a few simple things we need in order to conduct that initial benefit analysis. Once we've done that initial benefit analysis, we always recommend sharing that with your tax preparer or your tax strategist. So, okay, so now you're going to take that, Jonathan, you're going to get with your tax preparer and say, okay, I've got this building. These guys say they can generate this much depreciation. Can I use it? And will it result in a tax saving? So you want to check with your CPA always to make sure, just because we can create a large deduction doesn't mean you can use it. And so checking with them, making sure that you can use it is the second thing. Once you've done all that work, then you sign up with us. The IRS does require us to do a site visit. So we will go on site. That is either done in person for larger, more complex projects, or we will do it virtually for smaller, more simple projects. But essentially, a site visit is, if it's virtual, you would be on your cell phone, you're walking around the property. We've got our costing engineer on one end, you on the other end, and we're saying, okay, show us the flooring in the kitchen, show us the appliances, take us to the electrical panel, let's walk the outside of the building. And so what we're doing is we're gathering all that information, we're recording that video. We will go back and then we will take that video and we will start to measure how many linear feet of cabinet are in the kitchen, how much baseboard, how much chair rail, is there ceiling fans, are there garbage disposals, all those different things that we're looking for. How much of the electrical work is specific for short life assets? We can tell by looking at an electrical panel. So we're going to go through, once that site visit's done, it usually takes about 14 days for us to compile all the different components. And so we're going to look at things like when that house was built, let's say we're doing it on a single family rental, or let's say we're doing it on an industrial building. When that industrial building was built, someone had to pull a permit. What did that permit cost? We look at things, Jonathan, like when that industrial building was built, they had to put temporary fencing and temporary toilets on site for the construction crew. What did that cost? All that cost can be associated with that building. Even though you bought the building and the building was built 10 years ago, at some point that cost was associated with that building. And so we're going to separate all that out and put it into different buckets. Now, our deliverable for you and your tax preparer, it's about a 50-page report. Honestly, Jonathan, they don't care about the first 49 pages. Those are tax laws, case law, some details, but what they're looking for is a revised depreciation schedule. So towards the back of the report, there's a revised depreciation schedule that will have each item listed. We summarize it for simplicity. Well, each line item is listed with what the cost is and what the depreciable life is, etc. And so they're going to take that information, they upload it in their tax software, and that's how the deduction is realized. So for you, the investor, really there's not a lot of work for you other than maybe helping facilitate a site visit. Oftentimes that's done by a property manager or somebody else, but maybe you might have to help us with that. But other than that, and providing us some basic information, there's not a lot of work for you. We're going to do all the heavy lifting, provide you and your tax preparer that revised depreciation schedule. And that's the most valuable thing. That gets uploaded into your tax software, and that's how the deduction's realized.
Yeah, I can back up everything that you just said. As I'm an owner operator, I've done multiple cost segregation studies. I've done them on an office building, industrial buildings, on multifamily, and it's almost no work for me. I mean, I reach out to a representative and we have a back and forth. We did a virtual visit where I got on a video call for 30 minutes or so. We walked around the building, showed every room. And then a couple weeks later, I got the report back and sent it to my tax preparer. And so I don't know all the ins and outs about the portable toilets when they built the structure and carpet. And, I'm not there measuring cabinets and calculating square footage of carpet versus laminate flooring, counting light bulbs or anything like that. You as the investor don't have to do that stuff. Hire professionals and you trust great professionals to take care of that stuff. And then also, I love how you mentioned working hand in hand with your tax preparer. That's been a key component because everyone has such a unique tax situation. If you have other business income, to income, how the property is owned, if you have a spouse with high income. And in my experience, again, this is not tax advice. Neither Eric or I are giving tax advice. That's what your tax preparer is for. But the real magic can come when you're an owner operator and you have real estate professional status. And so that gets you some extra benefits where you can offset a lot of your earned income. So definitely something to talk to your tax preparer about. Let's go into kind of current day cost segregation. We were at one point getting 100% depreciation in year one. That was a few years ago. That was like the height of the real estate frenzy. We are not at 100% today as we speak. So can you give us an update about where we stand with depreciation today?
Yeah, no, great question. So Let me back up just a hair, Jonathan, and talk about bonus depreciation as a
Sure.
whole. So bonus depreciation essentially puts cost segregation on steroids. Bonus depreciation's been around for a number of years. It really had nothing to do with cost segregation in its infancy. Basically, bonus depreciation is a tool that the government uses to stimulate the economy. So if the economy is not doing well, they will increase the bonus depreciation amount. If the economy is doing well, they'll decrease it. And there was a couple rules that applied to bonus. One is you had to buy brand new stuff. They want to incentivize manufacturing. So they say, hey, go out and buy brand new stuff and we're going to incentivize you. That was the first thing. The other thing is you had to buy stuff that depreciated over 20 years or less. So a lot of tax preparers, even today when I talk to them, they're like, well, bonus doesn't apply to real estate because in order to take bonus depreciation, you have to have an asset that depreciates over 20 years or less. And remember, if you remember when we started, we said real estate depreciates over 27 and a half or 39 years. So had to be brand new, had to depreciate over 20 years or less. And at the time in 2017, it was 50% bonus. Now, what that means is if I went out in 2017 and I bought a $1 million bulldozer, I would get 50% bonus depreciation on that, meaning I would be able to take a $500,000 write off or 50% all in year one as an expense. The remaining 50% would get spread out over the useful life of that bulldozer. Fast forward it to the end of 2017, as Jonathan alluded to, Donald Trump was our president, Donald Trump owned real estate, and Donald Trump revised the tax code with the Tax Cuts and Jobs Act. Few things changed. One is they went from 50% bonus to 100% bonus, which was huge. So now, well, actually, let me back up. The second thing that changed is they added 5 words to the tax code. And I don't think the folks in Congress even knew they added these 5 words or knew the impact of adding these 5 words. But they added the 5 words, new to you, the taxpayer. I think that's actually 6 words. I told you I wasn't good at English. I don't know if taxpayer is one word or not, but 5 or 6 words. Essentially what they said is, hey, now I could go buy a used bulldozer that is new to me, the taxpayer, and all of a sudden I'm eligible for bonus. And not only am I eligible for 50%, I'm now eligible for 100%. So let's go back to that scenario. I buy a $1 million bulldozer. It's a used bulldozer, not even a new one, a used one. And I get 100% or the full $1 million write-off in year one. So I don't know how many listeners are buying bulldozers. Let's apply it to real estate. How does this work for real estate? Well, now after the Tax Cuts and Jobs Act, the 100% bonus was in place for any assets bought between 9/27 of 17, so September 27th of 17, through 12/31 of 2022. So if I bought a $1 million industrial building and I had a cost segregation study done on it, and in that cost segregation study, we identified 30% of it into those 5, 7, and 15-year buckets. Those are the buckets we usually will segregate stuff into. So if I segregate 30% of that, that's a $3,000 amount, and now I get 100% of that in year one. Now, what would happen in the past, Jonathan, is we would take the carpet, for example, and say, okay, in this industrial building, there's $10,000 worth of carpet. We would depreciate that carpet, not evenly, there's a little bit more to it than that, but essentially we would take that $10,000 worth of carpet, break it up over 5 years, and it would take you 5 years to fully realize those deductions. But with 100% bonus, we're now taking 100% of that carpet's value and writing it off in year one. And so there was kind of the golden ages there of, anything bought at the end of 2017 through 2022, where you were able to take 100% deduction on it, meaning it wasn't uncommon for people to go put $200,000 down on a property and then get $150,000 in tax savings by doing that. So now they're basically putting $50,000 down on a $1 million property. And so it was very easy, or not very easy, but it made it very worth your while to go out and invest. Bonus depreciation did start to phase out, as you mentioned. After 2022, it was 100%. Anything bought in 2023 was 80%. Currently, it's 60% here in 2024. And then it will slowly phase out 20% each year until 2027 when it's down to zero. In saying that, there was a bill put in front of Congress earlier this year in 2024 where they were looking to extend the 100% bonus through 2025. Now, it made it through the House almost unanimously with bipartisan support. It got to the Senate, and the Senate kind of killed it and said, well, we're in the midst of a presidential election, so we're not going to pass anything that's going to help either side right now. So they kind of just killed the bill. My prediction, this is just my prediction. I don't know that this will happen. I've got a pretty good feeling it's going to happen. I've heard some talk on it already, but they're going to put together a comprehensive tax bill. Now that we're through the presidential election, Congress will get together, put together a comprehensive tax bill. I do think the 100% bonus will be included in that tax bill, and they will extend it. Now, if they can get their act together and do this prior to February 15th when we start filing our taxes, then they will retro date it for 2024, meaning anything that any of us bought in 2024 may be eligible for 100% bonus if Congress can get that through before we start filing our taxes. Once we start filing our taxes, it gets a little bit muddy in the water because now people are going to have to go back and amend, and they might just do it for next year. But hopefully, everybody in Washington owns real estate and everyone wants it passed. So hopefully it gets passed, but we'll wait and see where we are in that. But that's kind of the current status or the current outlook of cost segregation. Remember, we don't have to have bonus depreciation to do cost seg. You still want to take stuff that's depreciated over 39 years and move it to a 5, 7, or 15-year bucket. But if we can add bonus depreciation, and if it can be 100%, that's a huge win for everybody in real estate.
And the key there is having great professionals in your corner. So it starts with a great tax preparer or CPA and combining that with a cost segregation company that knows what they're doing. And so when you get those two professionals together, it can make a dynamic team. I have both of those, and I don't know a lot about taxes, but I trust the tax work to the professionals in my life that do know a lot. Erik, you'd mentioned that there's 100% bonus depreciation prior to December 31st, 2022. And if I'm not mistaken, if you bought a property, say in 2021, 2022, and you haven't done a cost seg on it, you can still go back and do a cost seg and get 100% bonus depreciation. Am I wrong about that?
No, that's exactly right. So the bonus depreciation law that applies to your real estate is not based on when you do the cost seg study, but it's based on when your property went into service as a rental. So you're exactly right. If you bought a property in 2020, you've never done cost seg, you've been taking your standard deduction for the last 4 years, you can actually go back, do a cost segregation study on that property. The nice thing is, Jonathan, you don't have to amend your returns. There's a tax form that the IRS allows us to fill out. We actually provide that as part of our service with our report. We'll fill it out. It's called a 3115. And it's interesting, we're checking a box on that tax form that says we're going from an impermissible method of depreciation to a permissible method, and we need to fix our prior year's returns. Or we need that catch up. We don't actually have to go back and fix it. We just get all that missed depreciation on the current tax year. And so what you're essentially saying there is, whoops, sorry, IRS, my bad. I was depreciating my carpet over 39 years. I should have depreciated over 5 years. Here's the difference in those numbers. And now I want all that missed depreciation and I want it on my current tax return. So as we start to get into tax planning or tax season, if you meet with your tax preparer and they say, hey, you're going to owe a lot of taxes this year, Jonathan, you want to go back and look at any past properties where you haven't done cost segregation. Look at possibly doing that now, bringing all that missed deductions forward and using that to offset any of that tax liability.
So, Erik, I want to ask you about maybe the only downside that I see about cost segs, and that is depreciation recapture. So, can you talk through what a depreciation recapture is, where it applies,
Yeah.
and we'll go from there?
Yeah, great question. That's a question we get asked probably most often, and it's probably the most misunderstood aspect of cost segregation and real estate depreciation in general. Because whether you do cost segregation or not, you still have to pay depreciation recapture when you sell your asset. So when you sell one of your pieces of real estate, there's two types of tax you pay. There's capital gains tax and there's depreciation recapture. Now, the depreciation recapture is calculated based on how much depreciation you've taken. So I'm sitting here saying, take as much depreciation as you can up front, but then people will say, well, this is just a timing issue, Erik, because if I take all this depreciation up front, don't I just have to pay it back when I sell my building? And the answer is yes and no. You pay some of it back but you're paying it back at a lower recapture rate of 25% and saving the spread. So the idea is I'm going to do a cost segregation study this year. I'm going to create this large deduction. Let's call it 100,000 because that makes the math easy. So I'm going to do 100,000, or I'm going to create a $100,000 deduction. I'm in a 37% tax bracket, so I'm going to reduce my taxable income by 100,000, or I'm going to save essentially $37,000 in taxes. Now, in 5 years, when I sell my building, if I have to pay all of that back, but I'm paying it back at a 25% recapture rate, I saved 37,000. I'm paying back 25,000, and I'm cashing in on the $12,000 of spread there. Now, I've oversimplified that dramatically, but that's the idea. And I think I'll back into another example because it'll make more sense, because you're not actually even paying it all back, you're paying some of it back. So think about it this way. If I buy a property for $1 million today, and in 5 years I sell it for $2 million, when I go settle up with the IRS, I'm telling them that everything has doubled in value. I bought all this office and all this stuff in it for $1 million. 5 years later, I'm selling this office and all the stuff in here for $2 million. Well, the land has probably gone up in value. My walls have gone up in value. But certainly my dirty, nasty, stained carpet that's 5 years old is not worth double what I paid for it. So why am I selling my carpet for double and paying tax on that gain? If you remember, Jonathan, carpet's a 5-year asset. So after I've owned it for 5 years, what's the value or the book value of my carpet? Zero. Has no book value. It's fully depreciated. So I should be selling my carpet for zero, selling my building, my structure, for a higher amount. And what you're essentially doing is you're actually taking it out of the recapture or the 25% bucket. You're moving it to the capital gains bucket, which is either 15 or 20%, and expanding that spread even more. I know I just mentioned a lot there, but the idea here is don't sell your dirty, nasty carpet for more than you bought it for, and then call us and we'll walk you through it. But take your deduction at a high rate, pay back a portion of it at a lower rate at a future date, and then save that spread.
And I guess I'll add my commentary to it. It comes back to working closely with your tax preparer. I'm actually going through this right now as we speak. I'm selling a property that I did a cost segregation on a couple years ago, and I asked my tax preparer to estimate what my tax liability is going to be. So at least going into it, you have an idea. So if you do a cost seg and then end up selling, know that you're gonna have something to pay upon sale. And if you don't want to have something to pay upon sale, the answer to most tax problems in the real estate world is, of course, a 1031 exchange. And so if you want to keep kicking the can down the road, you can, of course, do a 1031 exchange, in which case you defer that that depreciation recapture till down the road, and you do not have to pay it upon sale.
Yep, you got it.
So as we wrap up here, Erik, I want to ask you just kind of your prognosis for cost segregation studies. We're now heading into 2025. Bonus depreciation is at 40% in the first year, I think. Should investors still be considering cost segregations? Are they still worth pursuing?
Absolutely, yeah. So I will say when bonus was at 100%, it kind of opened cost segregation to a lot wider range of investors. When I first started 8 years ago, we did very little cost segregation work on single family rental homes. It just, you buy a $200,000 home, there was no bonus at the time. And so you were getting your tax savings over the first 5 years. It was spread out. But you had to pay for a study. So you might pay $3,000 for a study and only save $1,000 in taxes the first year. Next year, you might save $3,000, and then you might save $4,000. Eventually, you would catch up. With 100% bonus, it was like, wow, I paid $3,000 for a cost seg study, and I'm saving $30,000 in taxes the first year. It was well worth it. As we start to see bonus phase out, I think some of those smaller investors or the smaller properties may not make as much sense. But even at 40%, if you're buying, let's just do the math real quick. If I have a $300,000 single family home, if we segregate 30% of that, which we typically do, that's about $100,000 worth of deduction. If I'm getting 40% bonus on that, that means that 40,000 of that 100,000 is written off in year one. If I can reduce my taxable income by 40,000 and I'm in a 30% tax bracket, that's a $12,000 tax savings in year one. And a study might cost me, $27 to $3,000 on that. So even at 40%, I still think it makes sense, especially if you're going to hold the property for a few years. When it gets back down to zero, if it gets back down to zero, it probably won't make sense on some of the smaller single family homes. But cost segregation still is very powerful right now. So we'll just have to wait and see what happens with Congress. I got a good feeling that's going to get extended, the 100% bonus. But again, I don't put a lot of faith in Congress these days. So we'll see what happens.
Yeah, and I mean, I've had properties in the past where I was like, well, I don't know if it makes sense. I don't know enough, about the topic to know if it makes sense. I just reached out to the cost seg company, and I've actually used cost seg authority several times. And you guys just gave me a free analysis, and then I forwarded that on to my tax preparer. And the tax preparer said yay or nay. And she's always said yes to me. And then I went ahead with it. And I didn't have to know the details. I didn't have to know the numbers myself. I relied on other professionals in my world to help me along with that. So, Erik, if listeners want to connect with you, learn more about Cost Segregation Authority, or get a free analysis for their property, where would you like to send people?
Yeah, so the best place is just our website. It's www.costsegauthority.com. So COSTSEG authority.com. From that website, my contact information's on there, you guys. Please use this as a resource. You can call me. I don't bill by the hour. I think my cell phone number's on there. Don't hesitate to reach out. So you can get my contact information, but you can also, more importantly, there is a form that you can fill out there to request a free benefit analysis on any of your properties or all of your properties. We're happy to do it for a whole portfolio. It's a great way to look at your portfolio and say, okay, I've got these 12 properties. Some of them are going to have a higher ROI than others in terms of cost seg, but let's at least run the numbers and see how much deduction you have available, and then use that and share that with your tax preparer to determine if that's a strategy you want to take on. I'll just add one last thing before we wrap up, Jonathan. And you mentioned it earlier, and you've mentioned it a couple times, and I really appreciate it because I've been doing this for 8 years now, and there is a huge difference between a tax preparer and a tax strategist. A tax preparer takes your documents, runs it through their system, and spits out a number and says, you owe this much in tax. A tax strategist will say, okay, what is your situation? What properties do you own? Where's your income coming in from? And how do we reduce your tax liability? And so as you, as listeners, start to build your real estate portfolio, and as it becomes more complicated, definitely reach out to a tax preparer, CPA, somebody who really understands real estate, because they will charge a little bit more money. This is not self-serving, by the way. We don't do tax returns at our firm, so this is not self-serving, but find yourself a tax preparer who does understand real estate, because they will charge you a little bit more money as your tax returns become more complicated. You've got more entities, whatnot, but they will find you extremely, extremely more amounts of deduction than somebody who doesn't understand real estate, who's just processing your return. So that's the best piece of advice I can leave you. And you mentioned it a couple times, but find a good tax preparer, surround yourself with a good team, because it makes all the difference in the world.
Absolutely. Don't be penny smart and pound foolish and go to just a run of the mill tax preparer that doesn't know anything about real estate, because a real estate specific tax preparer and tax strategist is going to save you way more money than it costs you for them to prepare your taxes. So well worth it to have a good relationship with a real estate specific tax strategist and tax preparer. Erik, I really appreciate your time. Thanks so much for joining me today.
You're welcome. Have a great one.
Listeners, if you enjoyed this conversation, reach out to either one of us. We love talking about commercial real estate and cost segregations. So reach out to us. We'd love to connect with you. Thanks for listening. We appreciate you. Until next time.